Money Show.
Personal Finance with Warren Ingram.
Warren Ingram from Galileo Capital is with us this evening. Warren is a personal financial advisor. He's an executive director at Galileo Capital. And it's such a lovely question that you're posing for us this evening, Warren. And it's this idea of if you've got your own business, and your own business needs not only your time, your energy, but it also needs capital, any money that you earn to pour back into the business to grow your business, which hopefully one day becomes your biggest asset, do you really need an investment portfolio? And how then, if you do you manage both demands? It's a big one.
You're right, and it's such a classic question from entrepreneurs. Whenever I speak to them about investing, they'll say if they're at the early stage of the business's life that they simply have no other money to allocate to anything except their business, and if they could get more money to allocate to their business, they would do that. And as the business grows and let's say it becomes more successful, then you find their level of confidence changes, and they start to say, well, I'm growing my business at 25 or 30% a year, and it's something I control. I have a huge say in how my business will unfold and how my capital will grow. Why on earth would I invest it, for example, in the stock market, which might only give 10 or 12% a year and could lose me 25% a year, and I can't control any of that? Are you crazy? Why on earth would I want to do that? Let me stay in my business and control my destiny. And I think it's a great question. I think it's it's not to say that sort of one shoe fits all sizes, but I do think that we've seen in real time, unfortunately, in the last year and a half or so, that great businesses with fantastic entrepreneurs can be hit by something like a pandemic, or in future a completely different economic shock, and suddenly a fabulous business becomes survival mode or closes its doors. And if that's the situation, then it's not just about generating capital growth, at the best rate possible for an entrepreneur. It's about saying, how do I manage risk? How do I start to spread the risk away from my business so that I keep my business and I keep getting good capital growth, but I find other assets that, that can protect me against inflation, can protect me against economic shocks, potentially in other countries, as an example, and if not other countries, definitely other industries, so that if something does happen to my business, I've got capital away from my company that's completely unrelated. And I think that's the purest reason I can give entrepreneurs to build up capital outside of their businesses, is it's actually just a way of managing risk. And at some point, especially successful entrepreneurs start to realize that their biggest asset being their business could also be the biggest risk to their financial position.
And it's such an interesting one, because I wonder how many people are tempted if they're successful at both. They've got a business growing very, very nicely. Perhaps the business is outstripping the returns that they're getting in their investment portfolios because they're good at running their business. They look at this investment portfolio, which is now this nice little nest egg, and they think, if I could inject that 5 million or 10 million or whatever it might be into my business, and I compare the growth rate I've achieved over the last 10 years versus what my stock market portfolio has generated, then I can make some real money. And that temptation must be very, very real as well.
Absolutely, and especially that sort of horse race that you're talking about, where they start to track their business against their portfolio, and always, I would say that a well-run business with a great entrepreneur should outperform a stock market investment. That makes all the sense in the world to me, because the risks the entrepreneur is taking is much higher than what the stock market is taking, and therefore you should be paid for higher risks with higher returns. So you're right. It's it is a great comparison that a lot of entrepreneurs do, and I always think to myself, if you ask them the other question, why don't you start a business unrelated to yours, just to do something completely different to mitigate risk? Then you start to see their eyes going a bit bigger, and they become potentially a bit more fearful, because they're saying, well, hang on, that's not something I know well, and that's not something I can commit time to and effort and the like. And then they start to see potentially the benefit of saying, well, okay, hang on, potentially let me put it in a share portfolio that that's either in an index or a unit trust, or it's managed away from my business and potentially away from the effort that I've got to put in as an entrepreneur. And hopefully it's spread across lots of companies so that I do spread those risks. But time and again, especially when their businesses are growing really rapidly, it's a really tough conversation to say to them, it's time to start sort of setting money aside away from your business, because it's almost like you're insulting all their children. They just can't think of anything worse.
So how then do you balance what is required? Because your business needs capital. You need a safety net just in case it does all go pear-shaped, because, hey, look, anything is possible. You may get sick. You may, not become incapacitated, not be able to run your business. And without you in that business, you haven't put the systems that Pablo told you to put in place. And therefore, it gets run into the ground, for argument's sake. There is no backstop. There is no safety net anywhere.
I think the answer is probably, maybe there are three phases to a business's life. In the startup phase, let's not even pretend to try and convince an entrepreneur to do anything other than back themselves and get their business going, because, starting up a company and accessing capital is incredibly hard. And there's just no way that you can convince an entrepreneur in that stage to move money away from their business. And I think it makes all the sense to me that you give it the best chance to get going. So it's probably once the business has gone through the startup phase and survival mode to sort of the next step, where I would be saying to entrepreneurs, potentially just pay yourself, almost a salary that includes a saving element, and use that saving element to start, even if it's just on a monthly basis, with cash flow that starts to build up away from your business altogether. And very importantly, that you choose investments that are completely uncorrelated with your company. So, for example, if you, to use a really simple example, if you've got something related to the mining industry, then make sure that when you have investments, that you invest in things that are completely unrelated in any way to the mining industry, so that if something happens to the whole sector, that it doesn't take you down with your, in theory, diversified investments. And so that becomes one way to start convincing entrepreneurs to do something, and especially if it's a small amount of money on a monthly basis that gradually increases. That sort of pain point is not as big as saying to someone, look, I need to take out hundreds of thousands or millions of rands out of your business to build up a portfolio. But really interestingly, it's when you talk to entrepreneurs in later stages of their business's life, especially when the entrepreneurs are in their late 40s, early 50s, they start to look at this differently, and they start to say, hang on, I actually do need to do something to protect my family, protect the assets that I've accumulated. And then it's often a case of saying, if your company is very South Africa focused, then it's probably time to start building up at least an overseas portfolio to get the currency diversification, other industries that just aren't around in South Africa. And I think that's probably the best approach I can think of for entrepreneurs. Early stage, I'm certainly not going to be brave enough to tell you to do anything different with your money. Keep it in your business, keep going, but then start to kind of think wider and broader and longer term about all the risks that you can't foresee, and all the events that could happen to you. And as you said, could be from health to economic to future pandemics. And realize your job becomes one of capital protection as well, not just within your business, but of your family's position and your own position.
Thank you, Warren. I think it's very thought-provoking, and I think it's really important for entrepreneurs, particularly as they start out. It's that little bit of money that you put aside into essentially a side hustle relative to your hustle. In a moment, I'd like you to answer me this question. It comes from Craig. If you're a small investor, is it possible to still reinvest your dividends, especially if the transactional costs are high? I hope that makes sense. It makes complete sense, Craig. It's a very good question, because everybody is starting out at some point. And when you start out, you will get a few rand in dividends from some of your best investments, and that's great. How do you deal with those dividends is what is crucial. Invest in the future you deserve by opening a Standard Bank Money Market Select Investment account. Not only has Standard Bank lowered the minimum investment amount to 100,000 Rand, but you can now earn a higher interest rate of up to 4%. You also get immediate access to your funds. Your capital is guaranteed and you pay 0 monthly management fees. So open your account today on the Standard Bank app or in one of their branches. Standard Bank, it can be. Standard Bank is an authorized financial services and registered credit provider. T's and C's apply.
Personal Finance with Warren Ingram.
Dividends are beautiful things. The dividend puppy calls them money babies. And it's whatever investor aims for, Warren, is capital growth. In other words, you buy something for R1, you hope it goes to 100 one day, but you also hope that each and every single year you get a few cents and then a few rand, and hopefully by the time the share gets to 100, you're getting proportionately huge amounts of dividend flow coming out of that investment.
Absolutely. And I think, for people to understand, when you invest in the stock market over a long period of time, the reinvestment of dividends accounts for about half the growth that you get from the whole stock market, over, let's say, a decade. And so if you're not earning those dividends, that's a huge compromise to your growth. So it's a critical point. And, if I look at Craig's question, it even more critical for smaller investors to find ways to not just strip those dividends out and spend them, but to actually accumulate back into their portfolios so that they get that compounding effect of the money babies making even more money babies as time goes on.
Because the value of sorry, Warren, I'm going to get excited about this. The value, and people talk about a 4% dividend yield, and you go, well, if I've got 1,000 rand invested, that's not very much money at all. In fact, it's 40 rand. I mean, what's the point of investing that back into the stock market? If I've got 10,000 rand, well, that's 400 rand. It's not very much. If I've got 100,000 rand, now we're talking. Now that's a chunk of cash that's worth reinvesting. People, I think, are a little bit embarrassed by little amounts of money sort of trickling into a bank account.
Yeah, and I think, that's I'd hate for that to become kind of concrete in people's minds. If you've got 1,000 rand, and by putting no labor, no day-to-day effort into your 1,000 rand, it's gone from 1,000 rand to 1,040 because you've earned dividends. That's a wonderful way to let that journey start, and always to remember that your 1,000 rand might also just get some capital growth. So let's just say it grows by 10%. Then all of a sudden it's 4% of 1,100 rand, and I know that's only be $44 or whatever the deal is, but it doesn't take long before you're suddenly looking at 1,004, 1,500 bucks if you just let that money ride. And so I think it's a really critical point to understand is it's about, if starting small is not a big issue. It's about letting the money stay invested and letting it grow on itself over and over again. And that's how you get to the real wealth. And you look at someone like Warren Buffett, Yanni Mouton in South Africa, a lot of them achieved their real kind of fabulous wealth only very later, much later in life, somewhere around, the late 40s, early 50s, because they left their money to stay invested. And that's the point where it started to really kick off. So if you're in your, whatever it is, your early 20s, late 20s, early 30s, don't be worried about or embarrassed about starting out small. Everybody started small, at some point. So I think for someone like Craig, if you're worried about the transaction costs, it's a critical point. I would probably let those dividends accumulate a little bit and then buy another share or another exchange traded fund, whatever it is that you bought. So very simply, if you bought the top 40 index, and you're waiting for that to accumulate a bit, there's nothing wrong with letting those dividends build up a little bit. And then when they get to a decent size where they can, absorb some of those transaction costs, then you reinvest again. Not ideal, because you'd like to reinvest every time immediately after the dividends paid. But don't worry about letting it accumulate a bit, and if nothing else, when those dividends come through, consider adding a little bit of extra money to those dividends.
That's the point. Bulk up your dividends. You don't just have to sit and put your 1,000 rand in and then wait for the 40 rand to come in. Add 60, add 600 if you've got it, add 6,000 if you've got it. I mean, just keep contributing, and as the dividends come in, bulk them up with a bit of extra cash that you've got to make those transaction fees worthwhile.
And then you've got to exercise patience, and I think that's the thing, for a lot of people, they always talk about that first million and how long it takes to make. And that's absolutely true. And if using your example, if you don't do anything to add to that R1,000, then it's going to take even longer. But every little bit that you can add to the account and add to those dividends, whenever you can, that speeds up your journey to the first million. And it's really quick from 1 to 2 million. It's just that first million is really hard. And the only way to get there is keep going, keep patient, and keep adding and watch the space. It does happen.
Do you know anybody who's written a book about that first million? Oh, yes, Warren Ingram wrote a book. He wrote them the wrong way around. I'm still adamant about this. I know you disagree. But he wrote a book, How to Become Your Own Financial Advisor, and the second one, How to Make Your First Million. I would read How to Make Your First Million first, and then How to Become Your Own Financial Advisor. That would be my preference. But you make that point so strongly in that book that, geez, like once you made that first million, then the money kind of starts to take care of itself. Of course, you need to keep adding to it. It doesn't just miraculously turn into 100 million. It only really grows exponentially if you keep contributing and keep harvesting the dividends and keep reinvesting those dividends. But you get that power of compounding money, making money out of money. And that's the magic money tree.
And it's amazing to see, the people that were profiled in that book, to watch, especially the people that that were or still are in business in this pandemic time. A lot of them, their businesses have been severely affected, but because they've got these portfolios outside of the business and they've learned the skill of patience and letting their assets compound. I'm not saying they're living through the last sort of 18, 24 months, without stress. But their stress is completely managed and much more tolerable, and they've got a lot more time to make long-term decisions, even though their businesses might be suffering. And it's simply that skill that they've learned now is patience, let the capital grow, and then don't eat into the capital for a whim. You use the capital wisely, and it looks after you in the bad times. And surely this is a definition of bad times right now.
Now, a fabulous question for this week on a word. What is alpha other than a car that breaks down? No, anyway. What is alpha when it comes to investments? Because you often hear people say, no, you got to add alpha, but it's like you got to pump iron and add alpha. What's alpha?
So alpha is what all the big fund managers sell you as their promise. It's their ability to do better than their stock market or their index. So let's just say, someone who manages a unit trust that invests in shares. If the stock market is growing by 10% a year and their fund is growing by 12% a year, then their alpha is the 2% extra above the stock market growth. So it's that 10 plus 2 to get them to the 12. Is their ability to generate alpha, and that's the promise that they make, I guess, and their reason for existence. Because if they can't add alpha, you just buy the index, pay the fund manager nothing, and you're getting the return of the markets. So alpha is the ability to do better than markets, and the question that everyone's asking nowadays. The theme in asset management over the last decade or two is: do fund managers add alpha? Do they actually have a reason to exist, or are they just great marketing engines? And that's the debate that's going on, furiously, all around the world, and South Africa included.
But alpha, when it comes, is lovely because then you feel like you are, you're getting your money's worth when it comes to the fees.
Yeah, absolutely, and I think I'm not a cynic about fund managers. I think good fund managers, they're a handful, but they are able to generate alpha. The difficulty is finding those good fund managers and the ones that are going to do well in the decade ahead, not the ones that have done well for the last decade. And so I always think it's too easy to say, well, I'll only do the one or the other. I think there is a merit in both index investing and finding good fund managers who can add that alpha. It does exist, and the thing about this is when they do add alpha, they add a lot, and so that's why they do still have a reason to exist.